It's a lot of hard work. Some of the things that helped me early on were finding people that were really good at things that I suck at. So knowing myself, knowing what I'm not good at. I'm not great at managing people day to day. I'm not great at the execution. But I found somebody early on in my partner who's the exact opposite of me. We brought in a gal shortly after that who really took that idea of having a management company.
Welcome back to Keeping It Real Estate. I'm Mike Roeder, your host from Granite Towers Equity Group. Today we have the privilege of speaking with a very accomplished syndicator, Ivan Barratt. From managing a single duplex to overseeing a portfolio of 6,300 units, 7,800 all time, Ivan's made big strides in the multifamily industry. His company, the BAM Companies, is not just a success story, it's an inspiration for many in the industry. So with that, Ivan, it's great to have you on the show with us.
Thanks for having me, Mike. It's good to be here right before the holidays.
You bet. And Ivan, I know your real estate investment career, started out with a single duplex, very similar to how I started in the industry. Before we start talking about your current successes and strategies, why don't you take us back to the early days and how did you get started in real estate? What drew you to that first duplex?
Yeah, so I'd have to go all the way back to being 7 years old. My brother was 6 at the time. And my father would drag us out of bed early morning all summer long to mow yards, pull weeds, rake leaves, whatever he needed for his rental property portfolio. We were his landscaping arm and absolutely hated it. Hated him for it at the time. But it would grow into a bug or a seed that was planted. And so by the time I got to high school, I really wanted to own and have a large real estate portfolio. My dream was to have a big company. Went to college to learn business and real estate and finance, and always wanted to own the large company, but really, wasn't really sure quite how to get there. Got out of school, had some sales experience while in school, and was able to get my foot in the door with a real estate developer in the early 2000s. Didn't pay very much. In fact, my trick to get in the door with him was I will work to learn. I don't need to be paid. I just want to learn how this business is done in the development arena. At that time, I thought I was going to be a big shot developer, and so I got this great education post college, working for a developer, getting to wear lots of different hats. We were doing multifamily for sale at the time because this was pre-2008. Anybody with a pulse and a social security card could basically get a loan. So we were selling condos like hotcakes. He was doing land developments, had some multifamily for rent, but I got to have a front row seat to the entire life cycle of a project, from feasibility, entitlements, financing, actual ground up development, and then executing on the eventual sale of that product. So it was a great education. I thought I knew it all. I thought I was pretty hot shit. In 2006, I had maybe 700 lots in the Class A suburb of Indianapolis, Carmel, and I would sell those to custom home builders. And I had a couple of condo projects going where I was the sales team. So on all these deals, if you add up the commission fee that I would be paid upon sale, I was going to be a millionaire. And then 2007 comes along and cracks start forming. And by late 07, early 08, it had fallen off a cliff, literally selling zero real estate. And that was an incredibly humbling experience. I found myself 200 grand in debt, which seemed like an insurmountable amount of debt at the time. I was negative cash flow on a monthly basis. I was living in one of those expensive condos that I had sold, living high on the hog. Made a mortal mistake and took out second loans to manage or to maintain my lifestyle until my ship came in on all those big sales. And sure enough, that ended up working against me. I'm also at the time trying to convince my girlfriend, who somehow is my wife today of 15 years, trying to convince her that I'm a good catch. And I'll never forget, Mike. She said, "Hey, if I were 200 grand in debt and negative 5 grand a month in cash flow, would you marry me?" And that was pretty much the bottom of the journey. That was a deep valley. Somehow I convinced her that I had a plan and we would get out of this. 2009 came along, and I found myself driving 45 minutes to a suburb where I hoped nobody would recognize me, and I would deliver pizzas at night just to be able to stay in real estate and get some cash coming in the door. We moved out of that condo back into my only rental property, which is a duplex, squeezed into 750 square feet from 2,000 square feet, and basically started digging ourselves out. And luckily, she had a job, and my goal was to pay down the debt, and started practicing small real estate deals, which was a big ego bruise for me because I always wanted to do big deals, but had no idea how I was going to get there. And so I would do real estate, anything I could get my hands on, helping people buy land. I had a lot of experience there, helping sellers sell things, helping buyers find deals. And that's also when I started BAM in 2010 as a property management company. Not because I wanted to manage the tenants and the toilets, as they say, but because I realized that if I could grow an actual business that could bring in cash flow, then I could scale this thing faster, and I would build this execution machine so that I could one day do big deals. So I was doing little multifamily deals. It had to be multifamily, so no single family for me. We managed a lot of that on behalf of some investors who would later become investors with me. But we just started doing little deals, and we built up that management company. At the same time, I was learning how to burr my own properties, but those would take a while. And what I found is that I could go sell Mike, living out of town, who's got maybe a couple units here in town. I could sell him on why he should hire me to be his management company. And that cash flow would come in much faster than locating a deal, doing the burr method, right? So I had this little portfolio of real estate growing, but I was able to scale management much, much faster. It's the hardest thing I've ever done is scaling that management company, especially those early days. But it makes such a huge difference now, today, where we only do Class A institutional assets, done almost 8,000 units in my career. Most of the properties we're buying now are 40, 50, $60 million acquisitions. Got about 150 employees up and down the management org chart. And we don't loan them out as third-party management anymore. We cut that off a long time ago. And now that beautiful machine that is BAM is there to execute our wealth strategy for my family, my partner's family, and now over 1,000 investors that come alongside us and partner with us in our fund structure. So we now go out and buy portfolios of assets to further reduce risk and increase the chances for a higher return to the investor.
Got it. Well, that's amazing, Ivan. I love the story. You went through some major pain back in 2007 and 2008, and I love that you didn't quit. You stuck to real estate, you made some shifts, and you kept going, which I think says a lot about your character. I also love that you said when you got into the development arena, you worked to learn. You weren't there to make a big amount of dollars. You were there to learn and to understand the industry so that way you could have success down the line. So that was fantastic. I would love to hear from you. What were some of your biggest takeaways from 2007, 2008, 2009 when you went through all of that pain?
The greatest gift of my career has been finding my partner. The second greatest gift, and was gift number one for a long time, was the GFC, was the crash early enough in my career where it humbled me greatly, right? But at the same time, I was young enough to where it didn't destroy me. I saw folks 10 years my senior, marriages destroyed, businesses destroyed, literally from practicing real estate in a speculative way. So it really showed me the difference between investing and speculating. I also saw large multifamily shops, businesses hang through that and in many cases grow. So I realized the kind of financing that they had access to. And so I really started understanding why housing, if executed well, can be such a great investment. You can't disrupt rooftops, right? The debt markets for multifamily finance, as you know, Mike, are some of the best debt that you can get of all the real estate classes. And I just had to figure out the management. And reading books and trying to grow a business, I learned very quickly that people are harder than the real estate. People make the real estate seem pretty easy. And back to that no quit attitude, I woke up to the fact that if I want to grow a big business, I'm going to have to figure out the people game or find the people that are better at that game than I am. And that would be harder than real estate. And I would get punched in the mouth and kicked in the teeth a lot, just like I did in 2008. But as long as I kept getting back up, trying something new, it's an iterative process, right? It's a lot of tinkering, growing a business from nothing. But if I would just not quit, then eventually it would start working. And we had this crazy idea coming out of there after the first couple of years in the management game, burning through people like revolving door in the early days of BAM. I had this crazy wild idea. I can see you're sitting down, so I'm glad you are. And maybe I'll just keep this between you and me. But if you can find a way to have a place where people want to work, you get better people who tend to do a better job and who tend to stick around for a while. And so we really started finding people that would help us focus on making BAM a great place to work. And a lot of management companies can't claim that, but we sure can.
Oh, that's amazing. Yeah, the culture within a company is so crucial, and the core values and who you're working with. And I think a lot of people or a lot of companies miss on that. And it's tough when you have so much going on, so many irons in the fire,
Yeah.
so many issues to resolve. So I think a lot of companies, focus on that last when that should be the greatest priority. And, Ivan, you had mentioned you've grown your team to 150 plus employees, in under a decade. How did you build your team up? How did you find the right people to come into the organization? How do you find A players? Because I know that's crucial in multifamily, is finding the greatest of the great, because it's going to make a tremendous difference on the assets that you own. But if you could speak on
Yeah.
that, that'd be great.
Yeah, again, I would go back to it's an iterative process, and no amount of books or classes or podcasts are gonna teach you how to do that perfectly. There's no way to bat 1,000. It's like being an all-star in baseball. If you're getting 40% hits, you're a Hall of Famer, right? It's a lot of hard work. Some of the things that helped me early on were finding people that were really good at things that I suck at. So knowing myself, knowing what I'm not good at. I'm not great at managing people day to day. I'm not great at the execution. But I found somebody early on in my partner who's the exact opposite of me. We brought in a gal shortly after that who really took that idea of having a management company where people like their job, where people are banging down the door to come work at BAM. She took that very seriously and took that proverbial baton and ran with it. And finding those key players early was really what started bending the growth curve up. And some of the things that we do now that have sort of grown through the process is multiple interview rounds. We have an executive coach that will also interview key leadership before they come to work with us. You're coming here to work in the C-suite. You're going to be interviewed by your subordinates, and they're going to have a say in whether they're going to be working for you or not. Lots of personality testing and rounding out, the experience and the know-how and the skill sets of the folks on the team, so that similar to any sports team, right? You've got different positions, and people tend to start specializing in different positions, which is a big advantage of growing a big company. Is as we grow, people here get to do more and more of what they're really good at, and the things that they don't love to do or that they shouldn't be doing get to be somebody else's job, who is much better, maybe much better equipped for that.
That makes sense. And,
We could
I,
spend 3 hours on this one, Mike.
I absolutely love it. It's so important. And, Ivan, if you could take back time and you had to redo it, is there anything that you would have done differently, with your company or your team, as you progress through the last 10 years?
That would be another 3 hour call. I mean, I'm still trying to get the time machine to work. And as soon as it does, I'll go back in time and change some things. But I get that question a lot, and I actually don't like answering it because there is no rear view mirror, right? There is no time machine. Um, I think Mark Cuban said it, best. You've just got to get in there and effing do the work, and realize that any founder, any entrepreneur, you're going to make a lot of mistakes. It's just about getting back up and trying again. It's an iterative process. It takes a lot of tinkering. Sitting behind a book or a class or a seminar is good at some points, right? But it can also slow you down. And so maybe not for everybody, but I'm a fire ready aim guy. So I'd rather get started today and adjust as we go than try to plan. Because plans are great until the first bullet flies or till you get hit in the mouth, then the plan goes out the window. Adam's saying is pretty good. Planning is everything, but the plan itself is pretty useless.
I love it. And you focus on multifamily. We were talking a little bit about this before we started the podcast today, but I believe the bulk, if not all of your portfolio is multifamily. So I'd love for you to go in depth on why multifamily, why you like the asset class. And then also, it sounds like you're specializing in A-class deals. I don't know if that's always been the case, but why A-class?
Yeah, sure. So we started like a lot of syndicators doing older vintage deals, 60s, 70s, 80s. And the market really helped us, informed us on where we would eventually get to. Excuse me. But what happened over the last 5, 6, 7 years was that cap rates continue to compress on 60s, 70s, 80s, 90s value add vintages. So cap rates on those asset classes got closer, and closer to the newer, nicer stuff. So we figured out a few years ago that we could buy newer, nicer assets, use our management operations to effect a huge chunk of the value add strategy, right? Because just like me and like you and like everybody else, if I can't add value, if I can't increase the value of the asset that I'm buying, then the returns won't attract investment capital. So we still have to get value add returns. We've just figured out a niche in the market where we can take less risk by buying newer assets that are maybe undermanaged or mismanaged in markets where we have a high conviction of rent growth. And then there's some other ways that we save on those operational efficiencies and find ways to add to the income. Multifamily for me makes a lot of sense. It is the most intense asset class on the planet to manage, but that's where the big returns come from. I like the fact, I said it earlier, we can't disrupt rooftops. People need housing. There's always going to be a percentage of the market that is going to rent. That may increase in the future, but even if it doesn't and it just stays the same with population growth, and you maintain, that low 40s rent to buy ratio, which I think is going to get more extreme right now in our current market, then there's a lot of demand for housing. I love the Midwest. Very thankful to be born here. It's a steady Eddie area of the country. It's the tortoise versus the hare. We don't get these big moves off the mean. Like I say, she doesn't boom here in the Midwest, but she doesn't bust either. And that really plays well for my approach to risk management. Again, like I said earlier, the financing, the ability to lock in long-term rates, the ability to get really great debt along with our equity makes a lot of sense as I view other real estate asset classes. And then, at the end of the day, Mike, it's a business. It's a P&L. Just like if you're buying an HVAC company or a franchise or any number of businesses, we go in and we as a private equity owner operator platform, we look for businesses where we have a high conviction of being able to drop more capital, more dollars to the bottom line. And when we find one that meets our high conviction of being able to deliver returns that maintain our track record, we've got one of the best in the industry. If I can keep it that way, that puts me in the Hall of Fame by the end of my career. But that approach as a business, I think, makes a lot of difference in how we approach multifamily versus just a real estate play. It's really buying and rolling up businesses inside a fund where we've got a high conviction of being able to add that value. It just so happens those are apartment communities in the Midwest.
Yeah, multifamily is what we specialize in as well, and those same exact reasons that you just
Yeah,
stated.
yeah. Now
People
you
move
won't hear
out.
me say it. You won't hear me say it's the best thing since sliced bread. You won't hear me saying it's recession proof or idiot proof, or things that a lot of the Johnny come latelys in our market have said over the last couple of years that are now paying for it. It's incredibly hard, but it's very very profitable if done well, as you know.
Certainly. And, I know one of your core values at BAM Properties is risk management, and you just touched on that a bit. You use fixed rate debt, it sounds like, to mitigate risk, lower leverage. Can you talk a little bit more on those two pieces? And then also any other, aspects that you integrate into your business to mitigate risk right now?
Yeah, we'll open up that a little bit. Fixed rate debt is one tool we use. We also use floating rate debt, but one thing that we have to be mindful of is when we're using a tool, right? We have to manage the risk that comes along with that tool. So we took on quite a bit of floating rate debt over the years. How we manage that, in addition to rate caps, is a lot of cash on the sidelines that can absorb those interest rate increases. So lower leverage, like you mentioned, was also a key in that. When you're taking on some floating rate debt, it's probably a good idea to keep your leverage lower than 70, maybe even in the low 60s at times. And then there's other times where it's definitely the way to go to put a fixed note on it and hold it longer. And what I love comparing it to, or the analogy that's my favorite, is the hammer, right? The hammer is a tool. It's not bad. It's not good. It's all in how you use it. You can build something really cool with it, or you can knock yourself upside the head and and damage yourself. Right? It's not the person. Excuse me. It's not the tool. It's the person wielding it.
That makes sense. And, with that, any advice that you have for investors that are looking to, start up an active investing career or looking to passively invest, Ivan?
Yeah, yeah. Active investors, I would say, start small. Understand that you're going to take some lumps. It's just a part of it. There are no shortcuts. So jumping into the deep end of the pool is probably a dangerous idea. I would take small baby steps, learn from those who have come before you, and read as much as you can, and understand that if you're going to be active in this game, it's a full-time job. It's a business. It's not a side hustle. The reason why we attract so many people and so many of these investors, I get this all the time, before they come to us or a syndicator like you, Mike, they're thinking, hey, I'm going to go buy some rental properties. I'm going to go buy a little apartment deal. And then they wake up and realize that it's a full-time job to do that. Managing the tenants and the toilets, we call them residents now, but tenants and toilets has a nice ring to it. Those water heaters are designed to only break on the weekends. The residents are only going to call you with a major problem when you're on vacation. And so a lot of our investors have careers, or their own business, or they're doctors, they're dentists. They've got a lot going on. They've got families. They want to travel. Maybe they've got some hobbies. And so you and I provide them a very worthwhile service, is that they can have all the exposure to real estate, all the benefits, without having to deal with the day-to-day operations. I love talking about active investors, aspiring entrepreneurs. I put a lot of content out about it, and I'm rooting for anyone that wants to get into this business and grow it. I just would caution them that it is a commitment. It is a demanding mistress. It takes a lot of effort to get this thing off the ground. And if that's what you want to do, more power to you. But it takes, I think, a lot of soul searching before deciding to jump in. And there are no half measures.
Yeah, I completely agree. And I think that's, sometimes where you see things go wrong in the industry is
Yeah.
when, someone with a full-time job where they're working 50, 60 hours a week and they have a family and they decide to syndicate an apartment, or they decide to go out and buy their own apartment, and they're not able to focus the time and effort on that property to make it a success. And that's sometimes where you see, things start to fall apart. So great
Yeah.
advice there.
And bigger is better, right? I mean, when you get into the large institutional type projects or 200-300 units, you've got on-site staff, people looking over it every day. You've got more budget to hire the right people, make the deferred maintenance, correct deferred maintenance, keep the asset nice. It is it's truly one of those economies of scale things that works so much better at scale.
It certainly is. And Ivan, what do you foresee coming down the pipeline in, moving into 2024 and 2025 in the multifamily industry? Obviously, there's a lot going on right now. I think it's a very advantageous time, to buy due to the pricing decreases. But what are your thoughts?
Yeah, we've bought probably four of the best deals we've bought in at least 3 years. In this downturn where transaction volume was off a cliff about 75% this year. We had some amazing opportunities to buy. We won't be selling much right now. We're in buy mode. As you know, the rates today, I think last I looked, we're down to 385, 386 on the 10-year Treasury, the reference rate, the rate that so much is tied to. That's close to 120 basis points from the high. The market seems to have already priced in a lot of rate cuts. I think that's going to save some people's butts out there. It's a really volatile time, and it'll be really interesting to watch what happens next and in the future. But you still got markets that are reeling with high interest rates, but also double and tripling of insurance premiums and falling rents. Areas like Phoenix, Vegas, a lot of parts of Florida and some other areas, even in the Southeast, are experiencing oversupply and these other issues. So I think there's still going to be some good opportunities to buy. Market conditions for us right now are really good to buy in our Midwest markets. I think there is a probability that could already be changing as rates fall and the market starts pricing in more Fed easing. You're going to start to see some of the institutions coming back into buy mode, which usually creates issues for operators like us that aren't these giant institutions that are willing to pay higher prices. So it's anybody's guess. We do less forecasting these days, and I look more at what are the conditions today and how do we find opportunities in those conditions? How do we minimize risk while at the same time having a high conviction in an asset being able to deliver those returns? We've sold several $100 million of real estate, about 12 exits so far, and are very proud of a 2.5x average on a 3.5-year hold, resulting in an average audited IRR of 35% on our first 12 exits. If I can keep my track record consistently anywhere close to that, the rest will take care of itself. It's not going to get any easier to find deals. I think folks that are waiting for some big bloodbath are going to end up waiting on the sidelines too long. The central bank is not going to allow some big bloodbath in real estate or some huge contagion. They're definitely going to shake out the weak hands, and the folks that bought high leverage bridge debt from debt funds that now are showing their true colors in many cases as loan to own lenders. Those folks are probably still going to get vaporized, but there's going to be a lot of capital reentering the market. So it's always tough to find a great deal. It takes a lot of toads to find that one that turns into a princess.
Yeah, I completely agree. I mean, I think there's some big headwinds out there in certain submarkets and markets, but at the same time, there's a great amount of opportunity, and there will continue to be, over the next couple of years. So
Yeah.
appreciate that, Ivan. Before we part here, do you have any favorite books? Could be on real estate, could be on personal growth that you can recommend to our listeners at all.
Yeah, I really don't read a lot of real estate books these days. But it's more self-development, biographies, and studying people and how they built a great scalable business. I'd say for the passive investor, my favorite book of late would be Richer, Wiser, Happier by William Green, one of the co-hosts of the Investors Podcast. We Study Billionaires is their tagline. Great book. Every chapter is a different Hall of Fame investor: Charlie Munger, Manish Prabhai, Sir John Templeton, and others. I think it's a great overall book on how to invest. Another one, How to Invest by David Rubenstein, who's big talking head on Bloomberg, owns Carlyle, one of the biggest private equity groups on the planet. He's got like 20 chapters. Each one is a different asset class. So if you're really looking to get into understanding all the different asset classes and the pros and cons of each, I think that's a great book. For the entrepreneur out there, oh gosh, my favorite book of late, man, I don't know. There's so many to choose from. Traction's pretty overplayed. Everybody knows about Traction now. I must have not slept enough last night. It's the Christmas season.
Not a problem. Well,
Oh, you watch Founders podcast or Invest Like the Best? It's not a
I
book.
have not. No.
Great podcast for the entrepreneur out there. Founders is one of my all-time favorites.
Fantastic. Well, we appreciate
Yeah.
those recommendations. And, Ivan, if any of our listeners want to get a hold of you, how can they reach out to you?
Yeah, pretty easy to find. I think my name's here on the video, Ivan Barratt, Barratt. Google BAM Capital or BAM. We usually pop up pretty quick. You can find me on LinkedIn, YouTube. Not as much Instagram these days. But if you Google me, I'm pretty easy to find. 317-762-2625. 317-762-2625.
Perfect. Well, Ivan, thanks so much for coming on to the show today. And for our listeners, please make sure to leave us a rating and reviews. It helps us bring on incredible guests like Ivan. And Ivan, thanks again for sharing your wealth and knowledge with us today. I really appreciate it.
My pleasure, Mike.